Following the Fed is like playing a risky game of chess, anticipating the next move. While the market is now better aligned with Fed projections, are there any risks to the Fed's path ahead? Like you and everyone else are probably wondering, what's the Fed's next move? We're going to break it all down for you right now on UBS Trending. Hi, everyone, and thank you for joining us. I'm Anthony Pastori, and this is UBS Trending. Leslie Falconio from the Chief Investment Office is back with me to discuss the latest. I mean, Leslie, it's every time you come sit here, it's like a different story, but it's also sometimes more of the same, even though it feels different. We're looking at Treasury rates starting to rise again. We're looking at a Fed that is kind of maybe scratching its head. The market is finally pricing in fewer cuts this year, so there's a whole lot going on. So in terms of the first quarter of the year, which is now behind us, we saw a lot in terms of the market's expectations of the way ahead for the Fed. And it's still playing that way today as we're in 2Q. So what were some of the performance drivers in there that were helping to play a role in the market, kind of talking about their expectations for the Fed without saying much about what they were planning?
Yeah, absolutely. I mean, when we think about the first quarter and our projection that we had at the end of December, beginning of January, there's some projections that we were actually fairly spot on, and there's others that I'm still even scratching my head.
Right.
And some of them being, if we start off with, our expectation was that Treasury yields would rise in the first quarter, simply because, Anthony, as you know, we stated this numerous times, when they, at the end of the year, when they priced in, a March cut and 150 basis points total for 2024, we thought that was much too ambitious. So we expected the convergence from the market and the Fed to kind of go together, right? And this would cause interest rates to rise. And we've seen that, right? Interest rates have risen. Now, because of the stronger than expected growth, we have first quarter GDP now at 2.8%. We have inflation that's remained somewhat elevated. Obviously, we have recovery in ISM. So that has sort of boosted yields a little bit beyond our expectations, but we also have targeted that 4.5% 10-year yield to really start buying again. Mm-hmm. So the direction of interest rates really wasn't the surprise. What the surprise was, I think, coming in is how well high credit embedded sectors performed, right? Meaning that when we look at those sectors that are obviously have a higher correlation in the equity market, performed incredibly well. And that includes, high yield, preferred, senior loans. And that was something that we didn't quite expect given the magnitude that spreads compressed. And the reason is that when we saw November and December, yields came down in December. We had a 373 10-year. Right? Financial conditions started to loosen, but these credit spreads still tightened and yields went up because of this. Okay, you have a stronger growth story, but we still believe the Fed's going to cut. Mm-hmm. And that is the key to why the credit sectors had really tightened in so well. The belief that the Fed will still cut in the second half of the year, which, by the way, is still our belief as well.
Right. So the market is pricing in fewer cuts than maybe they thought at the end of last year or the beginning of this year. What's the base case here at CIO now?
We still have 75 basis points of cuts starting mid-year, June and July.
And you're expecting what? At three meetings, 25 a meeting?
It's 25 a meeting, but you and I have talked about this. Whether it's June or July or 75 or 50 basis points of cuts, from our perspective, really doesn't matter.
Right.
What matters is, for the long term, what matters for us is, are they not going to do anything? Because as we see oil up 17% in the quarter, is this going to continue? Is there going to be some sort of reflation concern that either takes the Fed off the table or, to our bigger risk, the market prices in another hike again?
Right.
So, and that is not our call. We do think that they cut, and that's why we think yields go down in the second half of the year.
It's a bit of a conundrum, right? We talk about the risk to the Fed's path. It's because we're still watching economic data, as Jay Powell and the Fed are. We had some consumption data, personal income data that was like the highest since 2022. We have CPI, as you mentioned. It's been not linear. It didn't hit its peak and just continue to go down. It's been spiky. And we have CPI, that print coming out in a couple of days from when we're sitting here. And the jobs numbers, by the time somebody might be watching this, the numbers may be out. But as we're sitting here, they're not out yet. But there's still expectation that we're going to see growth in payroll, maybe at a slower pace. But the data still looks good. It feels like we have a strong economy. So it puts the Fed in a weird position.
It does, but I think that when you remember that if they do cut, and we think that they do three times, it's not as though they're going to hit a level that's incredibly accommodative for the economy. You still are going to have very high Fed funds rate. And I think that it's very easy, particularly now, for investors to get really wrapped up in every single solitary data point, right? And what the market is doing right now, which we expected it would do, it's starting to reprice in terms of repricing the Fed objective, repricing the path of the Fed, but it's also has, I think, it's paying a little bit too much attention to each and every data point, because we have to look a little bit longer term. And if we look in the 6 months or to the end of the year, growth is going to slow. Not in terms of a point where it's a point of concern, it could be around trend, but it is going to slow. And inflation, while it's going to be choppy, should over the long term come down. And again, that's with the assumption that you don't have some sort of geopolitical risk on the horizon.
Yeah.
But I think that's the important thing to look at, and particularly when it comes to fixed income, given the fact you have the ability, and and I said this earlier, when we hit that 4.5% 10-year yield, we are going to start really adding interest rate risk to our portfolio. Locking in those yields is a tremendous cushion and tremendous to total return. And whether or not it's June or July, 75 or 50, doesn't matter.
It doesn't matter.
We do think the Fed cuts, and it's not going to be cutting to a point where there's going to be this huge stimulation of the economy.
Right. Yeah, and we still have a soft landing, maybe choppy at the end. We don't think, and just to reiterate, you're not talking about deflation. We're talking about disinflation, which is just, it's still inflated, but at a lower and slower pace. So just to really kind of solidify what we specifically mean by that, there is a difference between the two.
Absolutely. And look, this market is a show-me market.
Yeah.
And you really, it just has to see that one less than expected, lower than anticipated number, whether like we saw in the retail sales, or something that shows, okay, we're starting to step back a bit, and then you'll see an entire shift in terms of interest rates. But for now, for the short term, if you get towards that 4.5%, really start buying.
Right. So in the last bit here, we have about a minute or so, Leslie. How are you positioned within the fixed income space for the months ahead, given what we just talked about?
We're not thinking there's going to be a huge catalyst for those credit-embedded sectors. I mean, it's not as though we think there's going to be a fat tail event, or do we anticipate a hard landing? As you know, we think just the opposite.
Right.
But spreads are actually very tight. There's no question about that. And even though total return is really based on yield, not spread, we think at this time, given how well the equity market is done, how loose financial conditions are, you probably might see some spread widening and lower credit quality. We do think that higher quality right now, given the ability to earn this yield and the ability to earn a lot of yield for the past 6 months, we think that's really the place to be. And again, we just have to wait for a little bit of softer economic data for the market to actually start shifting again. But now that the market has woken up and is pricing close to the Fed guidance, that's when I think that yields are going to start to come down.
Right.
It could be choppy in the short term, but overall by the second half, yields go to about 350, 375.
Yeah, and I'm glad you said it. It can be choppy. So for everybody watching this, don't get completely freaked out and think like the bottom's going to drop out. It might be a little bit of a choppy landing, but eventually we're going to hit the runway and level out a little bit.
Absolutely. And listen, Powell leads more on the dovish side, in my opinion.
Right.
He's a type of, he is looking to cut. He is paying attention to 3.9% unemployment rate. He is paying attention to the labor market. It's not solely about inflation anymore. And obviously that's a big driver, but having inflation stay higher for longer, I think is priced in. And having inflation reaccelerate, might be not.
Exactly. And Powell said in a quote after the consumption data came out that was really better than expected, he said, that was in line with our expectations. So it seems like the Fed is starting to really get closer to what they expect to see come out. So I think hopefully that means they'll have better decision making in a real situation, looking at the actual data that they expect to make informed decisions as we go forward. So it seems like we're hopefully on a road to start to calm things down a little bit. Yeah. Leslie, thank you. It's always good to get your perspective because there are a lot of shifts in the markets. So it's nice to kind of sit down with you once a month and just say, okay, where are we now? Good
Appreciate
to see you.
it.
Thanks, Leslie. And for more information from Leslie and the Chief Investment Office, visit our website at ubs.com/views. Plus, you can follow us on all the social media channels, LinkedIn, Facebook, Instagram, Twitter, or X. Plus, you can check out on Instagram our channel at UBS Trending. Lots of content there. And look, this is complicated stuff, so make sure you're talking to your financial advisor when it comes to managing your portfolio. Until next time, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.